Good evening, everybody. My name is Francisco Veloso, and I'm the Dean of Imperial College Business School, and I'm very, very briefly just to welcome you all here to this event to celebrate, this study, this work, which is quite important because, obviously at the business school, we care foremost about research, these intellectual contributions. But it's quite important when we find the opportunity to have these intellectual contributions in hopefully a way that is tangible, that's actionable, and it's a contribution that has impact and that people can link to policies and actions that make a difference for people. And so certainly this work that Tarun has worked on and with the team has certainly been with that idea in mind. And so it gives me great pleasure here just to welcome you all to this event to celebrate the completion and to present the work that's being done. And I'd really like to thank you all for accepting our invitation to come, and also for the Reverend Howard and Franklin Allen, who's going to come after me for putting this and organizing this marvelous event together. So thank you very much and enjoy the afternoon. Franklin, you have the floor.
Thank you, Francisco. My name is Franklin Allen, and I'm the director of the Brevin Howard Center, and it's our great pleasure to organize this event. I think this report is a landmark one. It goes into great detail into the Indian household finance. And it's not just important for India, which it obviously is, but I think financial inclusion is something that has become important for many countries. And it's important because if people just put money under the mattress or they put it in some other unproductive asset, it doesn't help the economy. But if they can put it in a bank account or some other kind of financial instrument, that helps the economy grow, provides jobs, and so forth. And so I think the results of this are not just applicable to India, as I said, but are much more important. And this is part of our agenda at the Brevin Howard Center, is to look at financial inclusion and see how things are affected by it. So it's my great pleasure to turn it over to Tarun Ramadorai, who will present the report.
Okay. Well, thank you very much for that introduction. I think the thing that I'd like to sort of start by emphasizing is that any report like this, which is fairly large. I mean, if any of you are having sort of trouble pitching a tent and you need something to weigh it down, then the report will help you with that because it's fairly large. A report like this cannot be produced by any single individual, and so there was a cast of 20 formally involved with the report in terms of the committee and various subcommittees and so on. But over and above that cast of 20, there were also 15 or 20 informally associated with the production of the report, initially speaking, and then another 25 to 30 people at least that the committee interviewed over the course of a total of 8 meetings that we had for the production of this report, plus numerous subcommittee meetings as well. So all in, there were about 60 to 70 people who pitched in to the contribution that we made, the contributions that we made in this report, which is about 200 pages long. So, I'll try and summarize what I can of the report in this fairly short half an hour, but I recommend it to you if you're having problems with insomnia. You might find it quite useful in that context. But while I'm here, what I'd like to do is to provide some of you with my appreciation to begin with, and thank some of the people in this room who, without whom this report would not get written. So obviously, Franklin Allen was instrumental. He provided detailed feedback, read early drafts, waded through the entire document on numerous occasions, which is, was amazing scholarly input for the report to begin with. And then, of course, the Brevin Howard Center supported this effort, and I'd like to particularly thank Joe Leask and Jazz Gill at the center and other staff, of course, at Imperial, who have been incredibly helpful in the production of this report. And finally, what I'd also like to do is to give some thanks to the drafting committee for this report. So there was a few of us that constituted an informal drafting committee, and I'd like to single out Christine Badarinza, who isn't here, who's at the National University of Singapore, and very kindly agreed to be a part of the research subcommittee, and Vimal Balasubramaniam, who is here, and who was my PhD student, and was incredibly helpful and sort of got roped into the effort, partly because he had a long-standing interest in policy in India. So when he becomes the next governor of the Reserve Bank of India, you'll know where it all started. Okay, so what am I going to try and tell you about? So I'm going to try and paint a sort of picture. The report is in two parts. The first part is about 100 pages long, and it's just a diagnosis of the issues. So it's basically a lot of original research that we did that involved 5 or 6 different surveys, household surveys, amounting to close to 250,000, if not 500,000 data points. We then also harnessed equivalent surveys from other countries around the world using microdata in each case, so as to provide a very solid evidence base for our recommendations in the end. So what this really is an example of evidence-driven policy. I hope you'll sort of see that at the end of this. But to begin with, let me sort of tell you what the terms of reference of the Household Finance Committee were. So it starts out sort of every formal committee that the government of India constitutes basically is signed off by some authority. In this case, it was the outgoing governor, Raghu Rajan, who signed off on the report and constituted the committee in the first place. And so every one of these committees has the terms of reference which it's supposed to sort of abide by. And the terms of reference here were to benchmark household financial markets in India vis-a-vis other major world markets, to then characterize the demand of Indian households in formal financial markets over the coming decade, to then consider whether the financial allocations deviate from desirable financial allocation and behavior. So it's about a benchmarking exercise also about whether it's optimal or suboptimal behavior that they're engaging in. And then to evaluate the design of new systems, the redesign of existing systems of regulations, and finally to think about financial technology and how it might be useful in this context. So as you can see, this is a fairly modest terms of reference that anyone can knock off in about a week or so. So this is, so as soon as we saw this terms of reference, we panicked, obviously, because this is an enormous brief. But what we tried to do is to do exactly that, which is to sort of do the benchmarking part of it, and then and only then talk about the research recommendations so that we had a fairly serious grounding for the policy recommendations that we made. So let me try and tell you what we found to begin with, and this will be useful to you even if you're not students of India to begin with, because it has comparisons across different countries around the world. So perhaps the right place to start is to look at a household as a balance sheet. So a household is a balance sheet just like any corporation. If you think about household finance, the household has a set of assets and a set of liabilities, and it's trying to optimize its financial situation in much the same way that corporations are trying to do the same thing. So what this does is it just equally weights all of the assets. So we're only looking at one side of the balance sheet, the asset side of the balance sheet in this case. And India is always to the very left in these bar charts. I'm just going to show you 2 of them. And then you'll see that we've also looked at microdata from China, Thailand, the US, the UK, Australia, and Germany as well, just as a comparison. So we wanted a sort of a fair cross-section of both developed and developing countries, emerging markets and markets that have already emerged. And what we did is, of course, go to the microdata and then averaged the allocations on the balance sheet for every single household in each one of these countries, and then these are the averages. Okay? So what does this show us? It shows us that in India, the average household's portfolio is comprised of roughly 80% real estate. Okay? So if I looked at all of the assets that the household held, including cash balances and so on and so forth, 80% of that is real estate, which is usually the principal private residence. On top of that, there's some allocation to durable goods. This might be automobiles, washing machines, whatever it is that households have at certain points in the income distribution, because this is a representative sample. This might be cows, okay, and other such things for people who are well down on the wealth distribution. As you move to the next asset, you see that there's this one color here, which is in gold, okay, because it is gold, right, which is about 10 to 15% of the balance sheet, and you'll see that it shows up in no other country around the world. Okay? So this is a uniquely Indian issue here, which is gold. And then finally, you've got retirement accounts, which you can see in India as well as in China and in Thailand are virtually non-existent, whereas in the other countries around the world, there's a substantial allocation to retirement assets. either through government-sponsored plans or through private allocation to pensions. So you can see here that there are substantial differences across these countries, but there are a few things that make India in particular quite unique. One is the very, very high allocation to physical assets. I'll come back to this later on. And also this obsession with gold, which we'll return to over and over again, because it turns out to become a macroeconomic problem when it's so widespread and so large. Okay? The next thing to do is to look at the other side of the balance sheet, which is the liability side of the balance sheet, and ask the question, are Indian households unique in this respect as well? And the answer is yes. Again, you'll see that by far the largest allocation of liabilities in India is unsecured liabilities, which is short-term credit, effectively. So you might have thought about this as a credit card or a personal loan, which is the sort of thing that households in other countries also do have, but they tend to occupy far smaller fractions of the total set of liabilities in those countries. The thing that's also worrying about the allocation of Indian unsecured debt is that it tends to come from informal sources, friends and family, money lenders, and it's not from institutional sources like banks. Okay? So even in these other countries, you might find that. China, we are reliably informed by most people we've spoken to, actually, and I think Antoinette actually mentioned this as well in a private conversation. They don't have too many money lenders. So the question is, these two might look similar magnitudes, but they're quite different from each other. Okay. The other thing you'll see is that there are gold loans. So the gold on the asset side serves as collateral for loans that households take on the debt side as well. So these are fairly substantial differences. Okay. Now, one thing that you might ask is, well, look, maybe India is just very different because the demographic characteristics of Indian households are very different from those in the other countries. And so maybe if you have sort of young households who are fairly poor, that don't have very much wealth, that you would expect to see these patterns. And so it's not really about India versus the US. It's about the fact that if the US had the same demographic structure as India, then perhaps you would see exactly the same patterns. And that's precisely the exercise that we conduct here, which is we say, if India behaved in relation to all of those demographic characteristics the same way that all of the other countries behaved, and we just plugged in Indian demographic characteristics into the relationship between asset holdings and liability holdings for the other households with their demographic characteristics, then would we see that India is fairly typical in terms of its behavior? If I just had the same demographic characteristics in India as in the other countries, would things be the same? And the answer is no. Okay, so the way that you can see this is by looking at these plots. So this is the average for the other countries. The little dotted line inside each one of these bars is what India would have looked like had it behaved like the other countries, but you plugged in Indian demographic characteristics. And it turns out, for example, in real estate, there's this big gap here between what you would predict if it followed the same relationship as the other countries and what you actually see. So there are these big differences here in real estate. There's another difference here in financial assets where India substantially underinvests relative to other countries. Pensions are also very low, even when I account for the demographic characteristics of India being poor, less wealthy, lower income, lower education levels, and so on and so forth. Mortgage loans, India should be taking more mortgage loans. If it has so much real estate, it should be collateralizing that real estate in some fashion against debt. It isn't doing that. Secured debt similarly should be higher, and unsecured debt should be far lower than it actually is in India. So all of these problems are not just problems. All of these manifestations are actually seemingly unusual. Now, I'm using the term problem, and I do so advisedly because we also have a fairly technical life cycle portfolio choice model in the report, which I guarantee will not be read by most of the policymakers who see this report. But this was just to provide a little bit more background and a little bit more comfort for ourselves that these patterns could not be explained by rational optimization in some way by the agents that we're studying here in the Indian economy. Okay, so just to sort of summarize what the major issues are so far, there's overinvestment in tangible assets in India and conversely underinvestment in financial assets. There's a near complete absence of pensions, which is not just a uniquely Indian problem, it's also a more widespread problem in developing countries, but certainly is also evident in India. There are very high levels of unsecured debt and low levels of secured debt given the size of tangible asset holdings in the country. So this high sort of obsession with real estate and gold, and a 5-minute conversation with the average Indian will tell you that this obsession is real. Okay, it really is something that they face. And it's mainly sourced from non-institutional providers. As I'll show you, this turns out to be a very large and important issue. there's low insurance penetration, and all of these problems, the temptation in previous policy exercises on the subject has been to view them as individual problems that require individual solutions. So at times there have been committees on just the tangible assets problem and gold. There have been committees on pensions. The pensions regulator is separate from the insurance regulator, is separate from the debt regulator in the country. And so there have been calls variously for an integrated regulatory framework in the country. But one of the things that I will try and demonstrate in the next few slides is that's an imperative, because it turns out that all of these are symptoms of the same underlying problem, and they must be viewed together, and the solutions must therefore be holistic for these problems. You can't just go around regulating one market, because essentially what happens is if you squeeze the balloon on one end, you're going to compress it, but then the air is going to come out at the other side unless you're careful. So what we need to do is to think about regulatory sort of oversight taken as a whole. Okay, so just to give you an example of how these problems are interconnected, I'm going to provide 3 or 4 different examples, and then I'll turn over to the recommendations, and then we can have question and answer. I'm looking forward to that, given Antoinette's considerable expertise in the area and her experience working on these issues. So this is from one of the surveys that we studied, which is the ICE 360-degree National Household Survey, which is the survey that the National Council for Applied Economic Research used to conduct, but now has moved over to a different company, in case you're interested. So when you ask the people in this survey, these surveys vary. They're variously between 10,000 and 55,000 individuals. The All India Debt and Investment Survey is closer to 180,000 individuals, so these are very large, especially if you think that the comparable micro-survey in the US is less than 5,000 individuals. Less than 5,000 individuals in the micro-survey in the US, which is used for all of these purposes, okay? Survey of Consumer Finances. In India, 180,000 individuals, okay? Just so data quality is not an issue in India. It actually is in some ways better than the data you get in other places. Okay, so if you look at retirement funding and you ask the respondents in the survey, over 50% of them tell you that they're going to finance retirement using a pay-as-you-go system within the household, which is their children are going to take care of them in their old age, okay? And you also see that they claim that real estate is not really a source of financing of retirement. It sort of comes lowest on the list. But that's not quite right, because when you look at the fact that children are going to be paying your pension, the way that you finance the children is that you purchase a large house, you and your children live in the house, so the children are consuming real estate services from you, and then they're paying you effectively rent by the retirement that they sort of consume in view of the real estate. So immediately you see that the retirement funding problem and the real estate problem are 2 sides of the same coin, okay? You can also start to see that there are other issues here, which is gold is also a way to finance retirement. So suddenly you see that there are different ways to do this. We'll start to see that some of these other problems are interconnected in the same way. But you can start to see, and we will start to paint a picture of a fairly traditional financial system, which has lots of benefits, but is coming under significant amounts of pressure as social structures change. And we'll talk more about that going forward. Okay, so turning to another sort of aspect of this, let's think about the risks that Indian households face. And this is from another survey, the Gates Financial Inclusion Insight Survey. And so the question that you ask Indian households is, what are the principal sources of risk that you face? Now, of course, primarily agrarian economy still in many parts, very substantially large part of the economy. Bad weather or pests destroy crops and livestock. But of course, the usual suspects also apply. Major medical emergency, damage to property or business due to a natural disaster, and so on and so forth, death of main income earner, theft, and so on and so forth. Now, all of these are classic insurable risks, okay? So households should be able to insure against these risks. Now, the question is, do households insure against these risks? Turns out insurance penetration is tiny. Okay, so now the question is, if there are these risks, many households face these risks, they turn out to have very substantial financial consequences, and they don't have insurance. How do they finance these emergencies when they happen? So let's ask the households what their sources of emergency funds are, and suddenly you start to see that friends and family occupy a pretty substantial share for all crisis situations. Okay, so 29% of households tell you that friends and family step in, but then you start to see that things get a little bit more complicated. Household savings, 26%. Now, loan from a moneylender, 21%. Okay, so fully a fifth of households who are facing these risks go to a moneylender in these situations. And then other contains things like insurance, but it's not limited to insurance. So this is a fairly small fraction. So now you start to see that the insurance problem, the absence of insurance, is the presence of debt. And so those two problems are exactly the same thing. So you might have thought that you could regulate the insurance problem on its own, but you can't, because you also have to tackle debt and the way that Indian households think about unsecured debt. Those two things are not different from each other. One is an ex ante form of insurance, the other one is an ex post form of insurance. Now the question is, should we really worry about this? I mean, does it really matter if households are doing this, taking on debt later on rather than taking on insurance ex ante? The answer is yes, we should worry about that. And the reason is because if you look at the interest rates on unsecured debt versus secured debt, you can see that when you take unsecured debt from institutional sources, these are basically what the interest rates look like. So the lowest interest rate you see from institutional sources is sort of very, very small. These are on extremely short duration loans when you ask households in the All India Debt and Investment Survey. And as you move up to the 100th percentile, the most expensive debt that they could possibly take, from institutional sources you're looking at about a 20% interest rate. And these are capped by usury laws in the country. So in some sense there's a strong amount of regulation that keeps these rates low. But we saw 2 slides ago that households take substantial amounts from moneylenders. So now the question is, what is the interest rate from non-institutional sources? And you see, I'll get to this in a second, okay? It looks like it's 0 up to the 40th percentile. That's not really 0. I'll tell you why it's not really 0 in a second, okay? But if you look at that from the 40th percentile to the 100th percentile, you start to see that the non-institutional rates are basically hitting 60%. So the difference is, if you don't have insurance and if you don't take debt from institutional sources, this area over here is really how much you're suffering. Now the question is, how much is that for the average household? And we'll get to that in a second. But the key to understand here is that this is not innocuous. This is a serious problem, okay? Now of course the other thing is that many households say that the interest rate is 0, and that's because these are generally on loans from friends and family. Has anyone in this room ever taken a loan from a friend or a family member? Is the interest rate really 0? No, right? So in India, what happens is the aunt that gave you the loan, you become their chauffeur for the rest of your life, okay? So it's basically an in-kind payment. It's basically an interest rate service payment. And this can be very serious for households at the bottom end of the income and wealth distribution. You're basically locked into these relationships because of a financial emergency that you faced at some point in your life. The same thing is true, by the way, on secured debt. Even if I collateralize the gold that I had, because some households tell you that it's the savings that basically step in, household savings, but in some cases those savings are pawned, right, rather than actually sold. And in that case, again, you're facing this problem where the secured debt interest rates are substantially high relative to the unsecured debt. Now, if you wanted to see evidence of this insurance versus debt problem, one of the things that we did in the report is we said, okay, let's just go look at states. Okay, we don't have a huge amount of information on this, but let's just look at states. And we'll look at the rate of participation in each of these states of the population that's surveyed in life insurance or pensions, okay? So this is basically saying, only 10% of surveyed households in a particular state participate in life insurance or pensions. And then on this axis, we basically plotted what's the incidence of non-institutional debt on average across the state. And if you didn't think this was a problem, this completely shocked us when we saw it. There's a perfect negative relationship between these two things, which basically says that the states in which you don't really participate in life insurance on average tend to be the states in which there's high levels of institutional debt. Now, of course, I sort of lose my economist badge of correlation and causation, and I made all of those errors, but at the same time, I mean, this is fairly striking, and it's something that certainly warrants further investigation, if nothing more. So these are fairly serious issues, but they basically go to the essential problem that all of these problems are interconnected, and there is a way to think about them together. So how did we sort of diagnose these problems in the report? So we have this sort of section of the report after the research and before the policy recommendations, where we said to explain household behavior, you really need to think about this as a system in which traditional systems of financial management have been employed for long periods of time. And they've actually served households extremely well. Okay? I mean, these traditional systems grew up in an environment where households were optimizing. So these are not fools. I mean, these people have been optimizing in response to the stimuli that they've faced and in the economic environment in which they've grown up. But the fact is that demographic structures are changing. Okay? It isn't the case that you have a wide population of the young anymore. You're having sort of less and less of those people on whose backs you can run a retirement pay-as-you-go within the household system. And societal expectations are shifting at a rapid pace, okay? So it may be that, people want to move to a job in a different location. People don't want to live in these joint family structures. They want nuclear families. So all of that stuff is putting things under pressure. We also found that financial goals are often driven by these life events, such as marriage. So if you actually ask households what is the top 5 goals that they're saving for, the second one is marriage, okay? The things like education and health and so on and so forth don't even figure in the top 5, which was absolutely astounding to us. Until we realized that basically, again, things like marriage are an ancient form of social insurance. You invite everybody to a very large celebration, and when the time comes and your number comes up, the people that you gave that wonderful celebration to are going to come and step in and help you. Of course, that doesn't happen anymore to the same extent that it used to. So this is now an issue that requires financial insurance to step in and fill the gap. Okay, so let me very quickly then tell you about how much better households could do by making a few simple changes. So you might be worried that the magnitudes here are not sufficiently large to think about. So what we did was we tried to just do counterfactuals. We said, okay, suppose households took 25% of their gold holdings and shifted them into financial assets. How much better would they do? What is the annual real income gain that they could make over their lifetimes if they did this? And so we did a few of these little thought experiments. So now, some of these comparisons, you can do some robustness. We did them as well, but let's sort of look at this. So suppose you divide households into sort of 3 groups: those that have very low gold holdings, those that have medium gold holdings, and those that have very high gold holdings. And then ask the question, if they shifted 25% of their gold into financial assets, what would happen? Okay? And it turns out that this is the cone of possibility for all of those households. And what you can see is that that cone of possibility is virtually always above 0. Okay? So they're always making positive gains when they make this shift. Now, of course, this doesn't account for the fact that the price of gold is going to alter and so on and so forth. So those of you who are sort of fans of equilibrium, which we all are as economists, will worry about the fact that these are counterfactuals that don't take into account price effects. But at the same time, it's certainly worth sort of looking at to see how large these effects are. And it turns out that certainly at the third tercile of gold holdings, the top 30% of households holding very large fractions of gold, on average they could make a 6% real income gain on average per year, annual income gain, by shifting 25% of their gold into something that's a financial asset. And that's a large number. Okay, that's a huge number. That's more than the rate of annual income growth on average in India. Okay, that's substantial. Okay. Now, if I look at the United States return profile, so basically what this does is it says, okay, well, maybe India had a really good run in the financial markets from 2002 to 2016. Let's just see what happens when we use the US return profile over 2002 to 2016. And this wasn't a really great time for the US markets because obviously there was a big crash. But even so, you still see that there are positive gains. They're smaller, more modest, but they still do exist. Okay. All right. What about health insurance? So suppose we basically said, let's stop. Okay, so this is moving non-institutional. Sorry, this is so what happens if households take health insurance instead of taking on short-term debt in the event of an emergency? Okay, so what happens if they ex-ante insure versus ex-post insure? And so what we do is we look at this for rural households and urban households, and these are the first, third, and fifth bits of the usual monthly per capita expenditure. Okay, so this is sort of groups of households sorted by expenditure. The households that expend the most in general, okay, tend to benefit the most in the rural areas. Now you can see that the cone of possibility is in this case always above 0. So moving to purchase insurance rather than taking on average short-term debt is always beneficial for households. It just turns out that those gains are actually higher. And in the tails, you can see for some of these households, these gains are as high as 6%. So the distributional consequences are also substantial. Okay. And then the third one is, suppose we took those interest rate plots, and we actually took the zeros there that they reported from friends and family as correct in this case. We didn't actually shift that. But even so, if you took all of your unsecured debt that was in non-institutional sources and you shifted it to institutional sources, banks and so on, again, you start to see that the cone of possibility is virtually always above 0. And on average, we're making 3.6% income gains, okay, if I moved this for all, so for business operation loans 1.9% for medical cost loans, and all loans is 2.5%. Okay, so if I just added these three things together, you start to see that the real income gains really add up. Okay, they're not going to integrate perfectly for all of these households. Some will experience some gains, some will experience other gains, but it sort of amounts to about 10% of real income growth. So this is basically by way of trying to convince people that these are issues where spending an additional unit of policy time trying to come up with implementing regulations here can actually be massively rewarding for the Indian economy. Okay. So I'm going to very quickly now just tell you, sort of where we ended up in terms of what we thought would be the principles that would guide our policy recommendations. And then I'm just going to flash up some slides. There's 100 pages of policy recommendations. I'm not going to take you through the details. I'm just going to tell you sort of the broad areas in which we made some policy recommendations, and then I think maybe we can focus on that in the discussion. Okay, so the guiding framework that we thought made sense for an economy that sort of is facing some of these issues and also has massive opportunity is, some of these principles are fairly general and they're universal. So you could think of applying these principles to an FCA in the United Kingdom, the Financial Conduct Authority, or to the Consumer Financial Protection Board. So what we thought was, obviously you want relevant financial products, okay? In particular, you want advice to be given to households that's a fiduciary standard. That's a serious problem in the country. Households are not getting the financial advice that they need. We diagnosed this problem fairly early in the process. And it's also the case that the distribution mechanisms for the financial products that households consume are actually all set up in a way that have entirely the wrong incentives. They sell households the things that they don't want. As a result, the households don't actually express demands for these products. And so this is also another reason why you don't see take-up of financial instruments, because households don't trust the system in the way that they ought to. We thought that intuitiveness was an important part of this, which is that you should integrate product design and communication with very natural patterns of comprehension and use. So, suppose, look, none of us really, I don't think, has ever really read the terms and conditions on our insurance plans. And certainly households who are at the lowest quintile of the education distribution have no incentive, no time, no ability to read these things. So the question is, can we design communication in such a way that they really understand what they're getting into at the point of signing up? Okay. We need customization. So households basically, not everybody gets their income on the first day of the month. Not everybody has disposable income all the time. So there's people who have, wages, they're day laborers, and there's lots of differences within the Indian economy. So we should be designing financial products to facilitate household-specific objectives and deal with household-specific circumstances. Scalability is really important in an economy of 1.2 billion people. Okay, so if you need a solution that's basically going to scale massively at relatively low cost. Now, this is a big ask. I'm asking for customization, so every person gets bespoke treatment. At the same time, I'm asking for scalability. What can basically bridge the gap? And the answer that most people are giving us today is that technology allows us to do some of these things. Okay, so as a result, many of our recommendations put technology front and center. Now, of course, there's a little bit of a problem here, which is that you can't be a technological evangelist and sort of assume that it's going to solve all of your problems. So without actually solving some of the incentive problems that exist in the system, because if you go and throw technology at a problem which has badly designed incentive systems, it can make the problem worse rather than making it better. So you have to solve both problems simultaneously. And then finally, of course, competitive pricing. Okay. So we had a bunch of recommendations. I'm going to sort of fairly quickly run through these. I'll just give you 3 slides on the broad thrust of our recommendations. There's 100 pages of these things. But in real estate and mortgages, we propose a set of measures to discourage real estate as an investment, thinking that if you need to purchase real estate in this country, it should be as a consumption, because of course you have this 80%. This is including recommendations to remove tax exemptions on homes as investments. My parents were not very happy when I told them about this recommendation for obvious reasons. Okay. Proposals to eliminate mortgage market confusion. It turns out that many of the ways in which mortgage rates are quoted in the country, it's a tragedy. I mean, it turns out that there's lots and lots of issues there. So this becomes, so every bank quotes a different rate. There's no common benchmark. You can't compare them across banks. Maybe this is one of the reasons why we don't see enough secured lending in the country. Gold was a big focus. We have a number of proposals to financialize gold savings. We suggest that we should sort of change the features of the product so that it might become more appealing. Gold turns out to be one way for mothers to transfer wealth to daughters in a fairly patriarchal society. Maybe you can have a default matrilineal inheritance feature where inheritance passes from mother to daughter for these things. This was a great idea. Bimal actually originally thought about this, and I thought this was terrific and it deserved inclusion. Option of physical redemption of the choice of the household. So this is basically saying if you care about tangibility, then this is something that we can help you. Now, of course, the other big problem with gold and real estate is that these are basically ways to evade taxes. Okay, so this is something that we weren't unaware of in this report, and so we basically then recommend a whole bunch of different things to bring gold into the tax net, record all gold transactions, and so on. If I ever want to go to buy jewelry, I don't think I'm going to be very popular in India. The jewelry lobby was not happy with some of these things. Pensions, make switching and choice in annuity plans seamless, increase transparency in the annuity market. For insurance, we have a whole set of different suggestions here. The insurance market is a big, important, and very, very complex, confused, not very well organized, bad incentives set up in that market. And so we have a whole set of policy prescriptions to rationalize distribution incentives, rationalize commissions. It turns out that actually you can't actually get redress for a product that doesn't do what it says on the tin, even if you're in a far-flung area, by delegating a representative. So every individual who has a policy that goes wrong has to take 3 days out, go to the city, file the complaint, go through the bureaucracy for a relatively low ticket size issue that actually for them is a very large amount. So what we propose is that you should allow collective mechanisms for redress. Okay, so sort of mini class actions should be allowed. Okay, financial advice, uniform regulatory standards, segregating advisory and distribution, imposing fiduciary obligations on advisors, and then finally, and perhaps the biggest chunk of the recommendations are on financial technology. Let's make know your customer requirements very seamless. It turns out we have this fantastic platform for identification. It's got a whole set of issues associated with it that we also dealt with. But of course, at the same time, if you can sort of do thumbprint-based point-of-sale identification in under 6 seconds, we literally had people come in and demonstrate and take photographs of their own iris and do KYC in under 5 seconds in front of us. That's possible in the Indian context. Faster than anywhere else in the world. It is the best system in the world today. And because of regulatory inhibition, we're not actually using these systems. So we have very strong support for these systems. But at the same time, what we say is you've got to have data privacy at the front and center of these issues. So you can't just take massive amounts of data. You can't just allow massive use of technology without having some supervision, some oversight. And we propose that data privacy should be a right of the individual and not just a consent-based privacy standard where, if you check the box, how many of you have ever read the consent form before you've checked it? I've never read a consent form. I'm sure none of you have ever read it. I can assert that Mark Lewis probably, being a lawyer, lawyers here, the two lawyers, they wrote the consent forms. Catch up with them afterwards. But exactly. So these are the problems here. So we propose that there should be a rights-based privacy framework. And then finally, we propose that there should be an essential minimum kit of financial products that should be just given to households, opened for them very easily at the point at which they open a bank account. There's a prime ministerial platform to do that, which is very effective. And we propose the creation of something called a regulatory sandbox to allow financial technology firms to operate more effectively. Okay, so lots of work have gone into this from lots and lots of people, and I, again, would like to thank them. This is a collective effort. So that's it from me, and we can move to conversation.
All right. And we first congratulate Tarun, actually, for this really, shall we sit, really very fascinating, I would say, milestone report. My name is Antoinette Schoar. I'm a professor in finance at MIT Sloan and also a visiting professor here at Imperial College Business School at the Brevin Howard Center. I know India a little bit, even though I'm not from India, through a lot of research that I've done in India. And I have to say, this type of study is really unique in bringing, in a way, advancing our understanding of the systemic issues of household finance in India. And you were in a very nice self-effacing way, you were saying if you put, if you want to go to sleep, you might read this. I have to actually say that I found it extremely riveting to read it, which you might think just shows you what a nerd I am. But actually, I think, the insights from this report are very fascinating. And what I in particular love, I have to say, is two things. Of course, the detail, the seriousness with which the data is treated and all the information that comes together. But most importantly, actually, the fact that the report takes a very holistic and equilibrium view of the Indian economy. If you listen to what Tarun just said, right, what we learn from this is that one of the big problems in India really is the lack or the underutilization of formal financial institutions on the asset side and on the debt side. But these two things are obviously interrelated. But why is that such a problem? Right? It's a problem, as Tarun was pointing out, for individual households who, instead of taking maybe lower interest loans from formal institutions that have much better cost of capital, instead they take moneylender loans at 60%. And that's not just because the moneylender are bad people. No, it's also the fact that they themselves have high cost of capital because they're not diversified, they're not well governed, right? And so actually everybody is rurally and locally trapped in a lose-lose situation. But actually, if you think about it, it has a second and in some sense as bad effect, which is actually that capital doesn't get aggregated into big pools of capital that then are professionally deployed, right? Because if you think what Tarun was just showing you, two of the big institutional lacks or gaps in India are pensions and insurance. But pensions and insurance in the US are some of the major institutions to promote investments and innovations in the US economy. If you think, there's some research by, one of my co-authors, Josh Lerner, who showed, for example, that one of the big driving forces of venture capital in the US was the change in the ERISA, the labor regulation that allowed US pensions to invest in venture capital private equity, which really led to an acceleration of technology and innovation investment even in the US, right? And you don't have this same type of aggregation of institutional capital in India. And of course, right, what I thought would be, kind of great interest to me to discuss with you a little bit is where are the fault lines or where are the crack points that prevent this type of aggregation? And as the report also obviously points out, where can we make improvements? And as you showed, Tarun, one of the very puzzling anomalies in India is mortgages and real estate, and the fact that people hold so much real estate, and as Tarun also pointed out, in a very unlevered way, right? So it's typically in the US, we see, mortgage goes hand in hand with the increase in house prices, but also the increase in home ownership. But that actually doesn't seem to be the case in India, which is puzzling and stunning, right? You also pointed out, which I think is a really neat finding in the report, that some of it might be demand, not just supply driven, because households see real estate as a way to transfer wealth to their children and insure themselves. But your report also has a lot of very interesting findings about where the limitations, the institutional limitations, right, of the mortgage market. And I thought, it would be very interesting to hear from you a little bit more of the depth of what you found on that dimension.
Okay, so this is great. So I probably should have said this earlier, but it's a huge pleasure to have Antoinette sort of here and asking these questions. For those of you who don't know, Antoinette has written an enormous amount of work about India, even without being Indian. I sort of wish that, I wish I had written as much good research about India as Antoinette has written. And it's a pleasure to have her here from MIT. So thanks very much for being here and helping us with this. So I think this is a really important question, and I think there are sort of a few different answers to it. So I'll start with, I think you're right. I think the emphasis has been in the report primarily on sort of micro issues, which is, we're trying to diagnose problems at the level of households. And we're saying that many of the solutions have to do with understanding the demand side better. And in some sense, that was sort of our brief, given that that was the terms of reference. So, other reports have sort of looked at the supply side, but this one sort of really tries to understand the demand side a little bit better. So, I mean, clearly one of the problems, just continuing on that micro theme, and then I'll get to the macro in a second, is that it seems like banks are not spending sufficient amounts of time trying to understand their customers better. Now, why is that the case? So it turns out that there's probably a pretty good macro reason for that. So it turns out that you get really interesting effects when you introduce competition. Obviously, there are lots of different problems that might also be associated with that, but one of them is that you have this effort to try to understand your customers better and price to customers better, understand their risks, price to their risks, marketing strategies that are sort of evolving to help them sort of answer specific problems. In an economy where 50 to 60% of the banking sector is nationalized, you've basically sat on competition for a long period of time. And the regulator is also extremely reluctant and wary wary of allowing even the private sector banks to do risk-based pricing or sort of move out of the comfort zone even slightly. So what we have is this odd situation where the conservatism, which has been meant to protect Indian households from sort of evil financiers, has also protected them from good financiers simultaneously. So what you've done is you've introduced a system of regulations in which it's almost impossible for you to make any progress. So that's kind of one issue, and I'd love to talk about that some more, and I'm sure you have some thoughts on that. But this is sort of has been a problem. And in a sense, reports like this one hopefully reassure the regulator that you can make certain changes which will eventually benefit customers in a way that's liberalizing, in a sense. So, financial technology is something that the regulator has been fairly scared about for some time. The second thing that I'll say is the sort of the bigger macro problem. So it turns out that there are incentive problems even at the macro level. So, I'm going to say this because it's, different people have had this in the public domain, but let's look at insurance, for example. So it turns out, and this has been said in numerous media reports, so I'm not sort of saying anything new, the fact that I'm saying it may be new, but is that the Life Insurance Corporation of India, which is a government-run enterprise, effectively puts out 60 to 70% of the policies in the Indian market. Now, the incentives for distribution are set up in such a way that if you take a policy, in the first year, the distribution commission to the agent for selling you a life insurance policy, they get 40% of the proceeds of the premium in the first year. So, in other words, if I sell you a policy and you pay me 100 rupees, 40 rupees of that goes directly into the agent's pocket. So they have very strong incentives to push policies at people. Now, the problem is that if I look at the second and third year renewal commissions, they crash regulatorily, legally, capped at between 10 and 15%. Okay? So what does that mean? That means that the agent has strong incentives to sell you a policy in the first year, but virtually no incentives to make sure that the policy is renewed in the second years and so on and so forth. Now, this must be viewed in context with another issue here, which is it turns out that if you don't pay on your policy for 3 to 4 continuous years in a life insurance policy, it lapses, which means it's gone. You don't get any money from that policy. If you go and claim if there's a life insurance event, they'll tell you, I'm sorry, your policy has lapsed, you don't get any money. What happens to the money that you paid initially, which is the other 60% that didn't go in the agent's pocket? It goes into the profits and can be booked as profits by the insurance companies. Back to the original point, 70% of the insurance in India is sold by the government. So this is odd until you start to think about this, and then it sort of makes sense, which is you're selling people policies that basically are financing the Life Insurance Corporation of India, which is indirectly financing the government's budget deficit. The government has no incentive to change the issues because the left-hand side of the government and the right-hand side of the government are in sort of operating in slightly different directions. So how are we going to solve this conundrum? And it turns out that these are big, deep incentive problems that need to be fixed.
And they all, I think it's a very fascinating topic that Tarun is bringing up, because it also points to human behavior, right? Because you could say, as a Chicago-trained economist, right, I could hear some of my professors from the past say, but why would people ever let it lapse? Given that this is one of the best financial products that they have, right? Yes, so the agent doesn't come around next year. They should be running after the agent, wanting to pay the insurance, right, and renew it, given that they know it's valuable to them. And so very often, right, we view the world through this very textbook rational situation or idea, instead of thinking about the fact that actually, especially in a rural context, people don't have an Outlook on their computer or on their phone, right? They don't have a whole system to remind them that it's the end of the year and the policy needs to be renewed. Or they might, like you said, they might not even have the time to go 3 days and sit somewhere to pay the agent and to wait for the agent and all that, right? And so this combination of the fact that people's lives, especially in rural areas, are extremely busy, actually, and extremely unorganized, not by their fault, but by the fault of their life, if you want, right? That it's not as convenient at all as us here sitting in, kind of in a beautifully climatized room with, all the gadgets you can possibly want, right? That makes actually the demand side, or makes the agents in their behavior what looks more erratic, but it's actually just that they have so much more management to do of their life than we have, right? Another way of saying this is, if you think about the type of risk management problem that an average farmer has to solve, honestly, if I had to solve it, I would be probably already dead, right? I mean, you think about, I'm sorry to digress, but it's actually in this context. I was trying to do an experiment, or run a project with sugarcane farmers in India that are actually, sugarcane is a huge cash crop. Sugarcane is virtually indestructible after 3 months of growth, which as a bank you should love, because it means I can perfectly predict the yield. Yeah. So, very little risk. And the other really beautiful thing is that the farmer cannot run away with the sugarcane. Why? For every mile, or every actually hour that you're not milling the sugarcane into sugar, you lose sugar, which also means beautiful capture at the mill, right? So it's the perfect thing to do structured finance. We couldn't find a single bank to do a program with us to actually provide formal funding to these sugarcane farmers. And it's exactly this issue that Tarun was saying, that the government banks that are operating in the rural areas all told us, this is actually a really nice idea, but why should I do that? I will not get rewarded for setting up this new product. At most, it can go wrong, and then I will, actually be blamed for it. And why don't you go prove that it works fantastically? And once you have proof of concept, why don't you come back and maybe then we will adopt it, right? Yeah. But the loss, of course, is that in the meantime, the sugarcane farmers go to moneylenders at literally 50 to 60% annual interest rate against something that's actually very collateralizable, even, right? And very low risk. And so this, bad juxtaposition between low incentives on the banking system, right? The complexity of financial management for rural or small businesses really creates this, all these issues that Tarun is pointing out. And, maybe we should talk about this now. The hope may be that the one thing that can push competition is technology, right? Because in your report, you also point out several opportunities where technology can make a big difference.
Absolutely. So this is an interesting point at which to sort of, one of the nice things about doing a Q&A is that you suddenly sort of recall all these little stories and things that happened during the course of the production of this report. So, over the last year or so, I sort of haven't known whether I've been coming or going, because I've been on planes back and forth between India and the UK. And there have been some fairly unusual interactions with various people during the course of this report. And one of them came to mind, because what you're talking about is the political economy issues that arise when you actually want to do regulation. And it turns out that these political economy issues can be extremely dangerous and very difficult, because it just means that the situation is likely to persist for extremely long periods of time without any change. So I'll give you sort of two examples of this that came up, and then I want to talk about technology, which I thought was a very good question that you asked. So to give you two examples of this political economy issue. So one of them is that, you know, we talked to the insurance regulator at some length, and I mean the nice thing about being an academic and chairing a committee of regulators is that you have a day job to go back to, so you can kind of say whatever you want, and it doesn't really matter very much. And so you have a certain amount of independence to be able to kind of, you know, to cull the wheat from the chaff, as it were. And at some point we said, look, you know, we've got to change these and rationalize these distribution commissions, and in particular, it's got to be the case that the 40% first-year commission has got to come down so that it's level, at least with the renewal commissions, and so, you know, let's set all of them at 15%. And literally, this was one of the responses I got, which was a very emotive and strong talking point from the insurance regulator, which was, do you know that there are 2 million insurance agents in the country, and you're going to deprive these people of their livelihood? Okay. Now this is an issue. I mean, it's not a small issue, but you know, it was a little difficult at the time to, you know, first of all, I was kind of taken aback by this because, you know, you don't want to be the guy who's kind of taking food off the table for 2 million people, okay? And that was really kind of that was the way the conversation was going. But it is particularly difficult in a situation in which the benefits are diffuse for very large numbers of people, fairly small in monetary terms, but aggregate to enormous consequences for households, especially in certain states of the world when they don't have insurance, when they particularly need it, and so on and so forth. But to sort of aggregate all of those, you know, little small positive benefits and put them against the big negative costs that are faced by the 2 million that you can see and feel, that becomes an extremely difficult trade-off in policy making. And it turns out that it is precisely in those issues that policy making sometimes gets extremely difficult. And I started to see how, you know, these conversations would become exceedingly complicated. A second story about this was when we talked about financial technology. You know, I can tell the same story at a number because it turned out to happen over and over again. Whenever you recommend a change that would make the market more competitive, the first people to shout really loudly against that are the incumbents. And it turns out that, you know, the incumbents are doing extremely well. I mean, they're sort of, you know, making very, very good profits. The thing that is extremely difficult to convince incumbents of is that the market is going to get a lot bigger if we do this, even though the margins are going to get slightly smaller. And it turns out that that conversation, so the first conversation is about, you know, a cross-sectional problem, which is 2 million versus 250 million, you know, but you can't really see the 250 million, but you can see the 2 million. The other problem is, let's do something today where you'll take a hit today, but tomorrow is going to be great. And everyone's like, listen, jam tomorrow? I don't really believe in jam tomorrow. I don't believe the market's going to get a lot bigger. This is not going to happen. Why don't we just stick to the way that we're doing business today? And so there's a very difficult conversation that has to happen at that point. Now, technology frightens the pants off of most incumbents. And it turns out that in particular, the thing that they're really afraid of is the small startup companies, because they've all seen what's happened with Amazon and with Google and now with Flipkart and with all of these indigenous sort of players. And it turns out, by the way, this is very interesting. Flipkart, which used to be a very small, this is basically the Amazon of India. It used to be an extremely small startup company. It grew to, you know, it's basically the size of Amazon in India today. They're now lobbying the government extensively, and they've set up a think tank precisely for the purposes of arguing that Amazon should not be allowed into the country. Oh, God. So this is sort of an interesting, you know, it works. Competition is really good when it benefits me, but it's not so good when it doesn't. But so what we decided was we were going to try and facilitate competition from sort of young startup companies. And so we proposed the creation of this regulatory sandbox, which is basically a sort of incubator that the regulator runs and selectively relaxes certain rules to permit financial technology firms to experiment in a fairly safe environment. And it turns out that, you know, many countries, including the UK, which pioneered this concept, have run these things very effectively. There again, what was super interesting was that the argument was, well, why do you want to put more regulation on these startup companies? Why should they have to come and talk to the regulator in this special thing? You'll just create more bureaucracy. when the financial technology companies themselves are telling us we can't really even get in to talk to the regulator because all of these big banks are always in there and they all have, they're going out to dinner with the governors of the bank all the time. We just can't even get 5 minutes with them. And so this was one of the big suggestions that we had. But you're right, financial technology is an answer, but will we get there?
And maybe, but you're pointing out a very important dynamic, right? That, of course, the incumbents want to protect their market. But what actually your report points out is that there are a lot of potential win-win areas where even the incumbents might understand that technology is just a way for their customers to express their demand better, right? Those type of wins actually, to me, seem often the first step into change, right? Sure. That, say, kind of life insurance company of India might care for the 2 million, agents they have running around, even though I suspect it was more a ploy to argue against you, right? If they could actually make it more efficient to distribute insurance, they would not blink an eye, probably. And for your, for the households, it would indeed be better if they, say, could buy insurance on the phone, or at least renew it on the phone, sure. Right? So those, I feel, in many emerging market environments have actually shown that they are potential wins on both sides, and they are less likely to get blocked than the true disruption of the market. Yeah.
No, you're completely right about that. I mean, it is true that one sort of wants to do incremental things, and so, in a sense, large parts of this, the recommendations from this report have been about what are the sensible things that we can do today. So, I mean, there are parts of it that are fairly plodding because, I mean, in a sense, you want to kind of get the small wins even if you can't get the big wins. And you're completely right that that's a really important part of this. Now, the other thing that I should point out is that the report sort of came out and was written while demonetization was going on. This was a really important sort of thing that happened in the Indian economy. Look, I mean, columns have been written about it, and I'm not going to spend too much time talking about it. There have been, there's been a fairly massive human cost of the program. I think that's fairly non-controversial to say. But one of the things that's kind of interesting in India, and I suspect this is true about political economy more broadly, is that times of crisis can actually be opportunities to get some interesting things done. And so certainly one of the things that happened was the government started the Payments Corporation, which has gone to a ridiculously high number of users in a very short period of time. Digital payments have actually taken off in a way that they never have before. And so it might be that what we'll see now is a more widespread adoption because people had no choice. Right. I mean, almost as an auxiliary, unintended consequence of a policy. So, I mean, this basically goes to show, without taking a stand either way, that both good and bad policies can have unintended consequences.
Absolutely right. It also actually points to, this digitalization of transactions, right, that you pointed to, that in my mind, there's still this huge potential for India in particular from mobile banking and mobile money in itself, right, which seems to not have been fully explored. Yeah. And there, I think, especially on the payment side, one could imagine that it can have actually big benefits for obviously the rural farmers, but also for the vast amount of migrants. I mean within country migrants that India has, and it is something that potentially the banks, again, might not want to block because it's the kind of savings that they anyway don't access, right? There's a lot of pressure often, as you started off by saying, to protect some of the pressure on the national banks because if, more efficient competitors come in, it might hurt the banks. But this type of very small ticket savings, right, that maybe would be unlocked with, mobile money or mobile phone banking is anyway not something that the banks capture right now. And I wonder whether, is that, kind of that opportunity, was that part of your brief?
So it's interesting that you should say, so there are basically two things. So the first is that, initially speaking, when the conversations got going about starting up the committee, there was a question that arose that I was when I was talking to the RBI about this initially, about whether payments should be part of the brief or shouldn't be part of the brief. And one of the things that I felt at the time was that, payments is a supremely important area of the economy, and it's obviously one of the obvious things on the expenditure side that needs to be addressed. But the thing that I sort of felt was, there's a different point to be made, and I think we tried to make that in the report, which is that, again, in some sense, people are focused on payments, but what they haven't done is link that to all the reasons that you need to do the payments in the first place. I mean, in a sense, again, regulation on payments has been all about, let's just make this particular silo more effective. But if you don't then talk about, how do I facilitate payments for financial assets, non-financial assets, management of liabilities, management of assets, do something a bit more holistic, then it turns out that, in a sense, this would have diluted a little bit the point that we were hoping to make, given the circumstances. The other thing that's interesting about payments is that in India there's been a long history of kind of, and this is one of the reasons why this UPCI is so fascinating, this growth in digital payments recently. Payments have been viewed as kind of this evil thing. So if you look at these sort of old Hindi movies from the 1960s and 70s, there's all these hawala transactions that people engage in that sort of, across borders and shifting money very quickly from one place to another, and it was always the thing that smugglers did and like evil people did. And so I think there's always been this kind of reluctance to sort of think about payments in any way that's very serious. And so you kind of get into that conversation. But maybe we missed the boat, because clearly that's the big success story in the economy right now. So
yeah, very fascinating. But instead of me keep on talking, I thought we should open up the conversation to the crowd and get some questions from the participants here. Yes, go ahead.
So on the point of mobile money, back in the 2000s, Hillary Clinton led an initiative in India to understand how to implement mobile money. And one of the insights was that women particularly were impeded from controlling their financial future because of the patriarchal concept within India as a whole. But there are certain states like Kerala, where I'm from, that is more matriarchal. Thank you. And so I wondered whether you noticed any nuances. And then I have a second question, 2 for 1 deal. I'm Indian. So second question is that some of the issues that you point out are potentially the same issues that protected India during the financial crisis. So do you feel that this, progress could also be a retrograde step as well?
Okay, great. So I think the first issue that you're raising is a really an interesting and important one, which is that, yes, I mean, I think these social structures that we find will sometimes inhibit sort of progress from happening. It's certainly the case that we encountered this sort of reluctance to allow things to happen through the mobile phone, because what it did was it would empower female participants in the household and so on and so forth. That having been said, I mean, this sort of varies, as you say, across states, and it doesn't just vary because of the fact that some states are matriarchal and some states are patriarchal. It's also because of the fact that in some states the management of the household, including the financial management, is generally done by the women of the household. Now, of course, for an international example of that, you must look no further than Japan, where basically, Mrs. Watanabe has been the name given by currency traders to large movements in the dollar-yen coming from Japanese household, the women in Japanese households who manage the currency very effectively. But we see that in India as well. What this basically tells us is that while there may be reluctance to adopt some of these financial technologies, the auxiliary and beneficial consequence of that is it also basically releases some of the women from the captivity in which the patriarchal society has placed them. So yet another reason to push the policy if we can manage it. Now the second issue is an important one, and I'm sort of going to take that one head on, which is that it was interesting because when the financial crisis came around, a bunch of regulators and policymakers that I know who are fairly sort of liberalizing in their inclinations said, oh God, one of the things that's going to happen now is all the guys who've been stopping us from doing a bunch of things, they're going to say, look at what happened to the US, okay? Now, And the answer is yes. I mean, people say that all the time. It is true that India has been shielded from the consequences of the financial crisis as they were shielded from the consequence of the Asian crisis. They were also shielded from 10% growth. They were also shielded from a number of different things that could result in an improvement in standards. Now, look, Danny Roderick would argue at Harvard would argue that protectionism is a perfectly sensible policy early on. What you won't find in this report is any statements about protectionism or the lack thereof. I mean, it's perfectly fine if you want to do it at home. Go ahead and develop the industry without opening it up to the rest of the world. But just do the things that households need and don't prevent financial innovation by indigenous players. So the argument is not about whether who should do it and who should benefit. It's about the fact that it should be done. So there's a way to do this. So let me put it differently. I mean, China is now trying to rebalance towards domestic consumption. We have an opportunity to do that right now in the country.
Absolutely, right. It's you can say it more brutally. The Indian financial crisis happens every day. When a mother cannot take a loan to get to buy medicine for a child that's suffering because there's just no financial market there, right? And so those are trade-offs, of course. But I think what Tarun's work really shows is that India is too far on one side and has a lot of gains to move even to the middle without exposing the Indian financial system to massive collapse and runs and all that, right?
I agree with that.
Yes, sir.
Thanks a lot for the thing. It was very educative to everyone here. What next of the report, right? I know you guys have tabled it. What do you think happens next? Because I think you gave a couple of examples of bit of incumbents getting insecure, etc. But I think you also have certain sort of homegrown economists sort of giving their own theories of how you can't impose Western markets. One from our South Indian who has the ears of the sort of the bigwigs, so to say. How do you sort of see that developing going forward, and what next from the report? Do you think anything tangible happens?
Okay, so no, this is a great question. I mean, I think this is the usual problem, and I was sort of warned about this when I took the report, which is that someone said to me, and I think it was Franklin that said to me, the work is going to start after you actually submit the report, the writing of the report. I've been trying very hard and to resist that, but I think one has to get sucked into this at some stage. So the good news is that some of these things have actually already been implemented. So it turns out that this, we made this argument that you should link all mortgage rates to a common benchmark and that should be the repo rate, because that turns out to be the only liquid rate in the Indian economy. The way that the banks argued against that in our case was to say the repo rate is a short-term rate, mortgage rates are long-term rates, how can you link the two to each other? The answer is you don't have to link the two to each other, you just have to quote the rates. So, if it's a short-term rate, you just quote a spread above the rate. I could quote a spread above, if there's a Mickey and Donald market out there, we could link the rate to a publicly traded Mickey and Donald instrument as well, and it would be fine too. But of course, this is the way that. Now, the good news is that the Reserve Bank has recently come out and said that that's what they're going to do. They're going to go for a common benchmark, common quoting convention, so the mortgage market is going to have a hell of a lot more transparency than it has. So that's one win that we've already had. There was also an internal working group that was working on these issues. I went and presented internally to the central bank. There were conversations. So some things are already starting to happen. Now, other things are fairly non-controversial. So some of the stuff that we've asked for has been stuff that has, the PMJD, the Prime Minister Jan Dhan Yojana, which was a big banking drive, built a digital platform that has 300 to 400 million people on it. Okay, now one of the policy prescriptions is, can we piggyback on that and sort of do a few other things, give them more insurance, provide easy savings products, do other stuff like that, index funds and so on and so forth. That's also fairly easy to implement, and those small wins I think will happen. I see that those will. As far as the bigger stuff is concerned, I'll sort of give you two responses. The first is, one can always continue the advocacy, which, the report has received a fair bit of media coverage already. And that has been a good thing, because the media coverage has been fairly positive, and so in some sense the fourth estate is kind of pushing the government to do some of the things that are in the report. There's been about a fair amount of stuff on it. The other thing is that it's also important to recognize that not everything in a report will get done immediately. So the way that the Indian committee process works, far as I understand from people who have done this over and over again, is that unless 3 committees say the same thing, then the government is not allowed to make a policy about it. This is not a formal rule, but it sort of acts as if it is such. Okay? So in some cases we were the second committee, so we will have to wait for the next one. In some cases we were the first, so we'll have to wait for a fairly long time for that to happen. In other cases we were the third, so I think we'll be fairly lucky there. And then of course the other thing is we'll have to wait for the moment to arise when particular governments turn up with enterprising policymakers who want to make this a focus of what they want to do, and then you'll see many of these things being implemented simultaneously. So it's kind of a broad, a long-winded way of saying I think things are happening and will happen, I hope.
So.
Yeah. Oh, okay. Yeah. Sure. All right. Then we'll.
So,
Yeah.
I mostly back fintech companies, mostly in India, some here as well. And alternate lending is one of my favorite themes. What I found was in the unsecured loan in particular, about 60 to almost 80% is MSME, people taking personal loan on their basis and putting money in their enterprise. So what does that have implication in terms of what kind of policies you make? Because that's slightly different to someone taking for emergency or any kind of event-driven loans, if you like.
So that's a great question, and you've asked it exactly at the right place, because Antoinette's a big expert on MSME stuff, especially in India. So I'll sort of hand that one.
And the second one, just an observation. I'm like, yes, when I did a big road trip just to understand this sector a little bit better, one thing I observed from moneylenders' perspective is their credit knowledge is next to none.
Right.
As in, they exactly know who will pay back. They might have a gun, some of them,
Sure.
on the side, but
Yeah.
they exactly know who will pay when. And it's very convenient.
Yeah.
It's cash in the hand, no document signed, no nothing. Here you go. Here you have the money, and it will roll over whenever they know it will roll
Sure.
over. That's the model.
Yep.
So that's the observation. That
Okay.
Right.
So why don't you take the first one, and I'll take the second one.
I mean, to the second question,
Yeah,
I think
sure.
what you're bringing up is that the timeliness, it's not just the interest rate, especially for MSMEs, right? We know that they're actually relatively interest rate insensitive, but the timeliness of when you get the money becomes very important for small businesses. We've seen this everywhere, not just in India. And therefore, the fact that, like you said, money lenders, because they think or they know that they can enforce by many different means, right, means also that their decision process is very quick. While often, right, even the government subsidized MSME schemes that are much cheaper and probably the person could even get, right, will take a month before it gets approved. And that's just not something, as MSME want to get involved with. And so I think, so if I understood your first question well, is kind of that you were saying that it's true that in India at this point, MSME lending is a huge market, but it's all, well, it's majority informal, right? And in my opinion, it's for 2 reasons informal. One is all these issues of timeliness, and that the large banks don't want to invest in unsecured lending to these to these businesses because it's extremely costly, right? I mean, there is no functioning credit bureau for small businesses. And even seizing assets becomes actually quite difficult from these businesses. So as a private financial institution, you have to pay for a lot of the enforcement that in a system that would, say like in the UK or in the US or in Germany, right, when you have a credit bureau, when you have good, enforcement mechanism, all that becomes a public good, right? And so the institutions themselves don't have to actually pay for all of this themselves. And I think that really holds back MSME, small business lending in India to a large degree. The other thing, we should just be honest about this too, is that, this is kind of where demonetization maybe even started, right? Is that there is a 35 to 40% tax gain from right, going to the money lender and not going through the financial, formal financial system. And as long as taxes on small businesses are high, are cumbersome, right, bring with them other types of regulatory enforcement that are, kind of not conducive to business, you also can understand that these businesses don't have an incentive to come into the formal system. The one thing, and then I shut up, where I actually have seen some really interesting dynamic is that the fact that there is now, however, a formal financial market that functions a bit better, right, has grown already and has much better cost of capital. What has started to happen is that the best and the most ambitious of the firms realize that if I want to grow, I want to access that market, right? And so then, being small, you were bringing this up before, right? Being small and saving 30% or 40% of taxes might be fine if I have no growth ambitions, but when I'm, want to actually be the next, Flipkart or whatever, right? I will have to access formal financial markets. I will have to be at least gray, not black, and so actually those dynamics start happening, right? So in some sense, you could say that a well-functioning formal financial market can have transformatory effects on whether people still want to stay in the black economy or not. And that's why I think it's so important, the report and the findings of Tarun, to, in a way, to help make this market more efficient, more transparent, and better functioning. Now I shut up.
So you're completely right that the informal networks are working in many cases better. Chapter 3, I believe it's chapter 3 of the report is all about that. So if it basically lists a lot of these issues. And when we interviewed these guys, in many cases, they were far more savvy about any particular situation. They utilized social networks. They were very efficient information aggregators. The report basically says that what we need to do is to find a formal financial system that can bridge that gap, that can be as effective at doing the things that the informal guys do without the gun. Okay? So, you're perfectly right about that, and that's something. But also, you're right to point out that you get a tax advantage from being outside the net. I'll tell you another interesting anecdote that's just come up. We interviewed some people. One of the people we interviewed, we said, how do you go and get credit and how do you do all these things? He says, I just go to the informal system. And then, we said, look, but okay, you go to the informal. Why don't you go to the formal system? He says, they will ask me for a ration card and for a labor certification, an employment certificate, a domicile certificate. He says, no, I avoided all of those things. I didn't get a domicile certificate. I didn't get a ration card. I didn't get. So, so we sort of looked at the guy and said, well, but you don't have any identification. Like, you don't exist. So, like, why don't you do this? You can't get anything. He says, you don't understand. He says, nobody knows that I exist. Which was a huge benefit, actually.
Exactly.
I was very proud of that. So,
I think
okay,
we can take one more
yeah.
question and then we need to break in time.
Yeah, given the significant urban migration that's taken place over the last 20, 30 years, do you think whether you've got data when you dissect that 180,000 sample, what are the distinct differences between the rural versus the urban? Be interesting to see that. The second thing is, we all know the informal sector lending and the pernicious influences it's had over so many years, and yet it doesn't appear as though the government is even remotely interested in tackling it. Now they've introduced GST as a way to sweep in all the informal trade. Why have you think they have not tackled this informal lending, which is such a killing effect?
So I'll take the second question first. So the informal lending is interesting, right? So suppose you stop it and you don't provide an alternative, then actually that's welfare reducing. Because what you've done is you've deprived households of the only source of emergency credit that they can have. So what you can't do in these situations is ban things, because the problem with that is that you're actually, this is like, you kind of don't want to perform radical surgery without having an alternative. No, I completely agree. But all I'm saying is that's been a stubbornly persistent problem because in order to get rid of a sector, what you have to do then is you've got to create an alternative. The fundamental problem lies in the fact that the state-owned banks don't have an incentive to lend at the last mile at a low ticket size. Okay, they just haven't had one, and they're struggling now because all they've been doing for a long period of time is lending to very large ticket borrowers who are the worst credits of them all. We're seeing that problem play out in the bad loans problem in the country at the moment. Whereas what they should be doing is fairly frugal innovation, giving lots and lots of small ticket loans, because we know the productivity of those loans is higher. Now the microfinance sector attempted that. Then there was this big problem because they didn't understand the multiple indebtedness issue, because as you say, there's no credit registry for people, so people were taking 2 and 3 loans at the same time. So I think the way the problem has been that either people have had a sort of desire to ban, or there's a desire to do ex post evergreening, where you basically then just you make sure that like for example, loan waivers for farmers is a classic example where you want to do it at the time because obviously you don't want farmer suicides, because this looks terrible, and it's a horrible human cost, but at the same time this is creating a moral hazard problem and incentives for the future that financial economists understand. And then the third problem has been that you don't create auxiliary systems that can replace the formal systems, and these have been very hard problems, stubbornly difficult problems to tackle. I think you're right to say that there are differences. We look at those differences between rural and urban, and what we do find is that there are substantial differences. But to think that the problems are restricted to rural India would be a mistake. It turns out that many of the problems get worse when people go from rural areas to urban areas, a massive amount of rural to urban migration, because what then happens is that you suddenly have many more needs because you face very different risks. And you're even less well equipped because your old social networks don't work anymore. You don't have the new social networks to tap into. So in a sense, you have to tap into the formal financial system, which is really not solving problems for you. So those can be very difficult problems to begin with. I saw someone had their hand back there.
Right,
Maybe we
exactly.
can take one more question. Yeah.
Thank you for noticing me. I just wondered, because the Prime Minister of India, Prime Minister Modi, has been talking a lot about the young population of India, and very proudly so. Looking at your statistics, it sort of seems like a traditional old habit, sort of. I'm just wondering, also looking at the example that you've given actually about the sugarcane, side. I'm just wondering if there could be any uptake for creative solutions from within the private financial institutions or semi-government institutions, either at the microcredit level or via private sort of institutions. And how would that change those statistics, say, in the next 50 years or so? Thank you.
Yeah, I mean, so look, I mean, here's a fairly jaded, slightly cynical characterization of the type of competition that occurs in the Indian financial sector today. So a sort of a caricature of what's happening right now is the government makes some rules. Financial firms try to figure out the best way to do exactly the same thing that they're doing, but optimize it in a way that's going to best take advantage of the profit opportunities offered by regulatory arbitrage by the new rule. The government sees that the banks have basically gone into this new business, which is just about on the margins of what's legal, newly legal because the regulation changed. The government comes in and regulates again, and the whole game goes on for a while. Okay? So I mean, that's a fairly cynical characterization, but I think most students of the Indian financial sector would say that it's also a fairly accurate characterization of what's been going on. So now the question is, how do you actually get an environment in which you get true innovation in this economy, especially in financial sector related things? And I think one of the answers is that if you have platforms that are built for other things, they permit levels of innovation that haven't otherwise existed. So what the government can do, I think, to sort of help things along, rather than trying to regulate a fairly complicated regulatory environment already. I mean, right now the regulatory environment is really good for one thing. It's like it's good for keeping applied economists like myself busy for long periods of time. There are lots of things you can study.
And lawyers.
Yeah, exactly. But one thing that they can do, which they've been fairly successful at doing recently, is building large-scale platforms on which people can then innovate. So for example, the universal identification system provides this fantastic platform, and suddenly you've seen this proliferation of new innovations that's happened. So I think the thing to really think about is what else can they do that's at a fairly large scale that the private sector is unable to do, that puts in place platforms or pipes that can then be utilized in some fairly effective fashion. But
right, I very much agree, right? And there are some hopeful signs, like you're saying, right? The young in India are very savvy on phone and mobile phone and cell phone. We just finished actually, with Jana Lakshmi, which is a small business bank in India, a big project with the World Bank to test whether you can roll out financial literacy training via cell phones, even for people who actually don't have smartphones or might not even be literate, right? Just through push calls, push messages, and allowing them to call back. And because, exactly as Tarun said, that's a platform that's relatively cheap, where the marginal cost is extremely low, right? And we found actually that it's possible, even in such a lowbrow way, if you want, to provide financial education to really micro businesses. And we did a randomized control trial and actually found that it improves people's management of their businesses. Now, these are small steps. And remember what Tarun said at the beginning, of course, if you could, make a big holistic push and get, better, say, collateralization, much more enforcement, all this immediately fixed would be wonderful. But I feel the one thing that, I can say this as a non-Indian, it doesn't sound, but, kind of as an outsider, I am actually always insanely impressed how much actually resourcefulness and how much creativity you have throughout the population. And the other thing, which is a byproduct maybe of, not being a developed country, is, but you see people that have so much raw intelligence, right, that have not actually had the opportunity, say, to go to an IIT or something, right? But their intelligence allows them, even in their rural or local economy, to actually create new things and very, ingenious things. And so I do believe, actually, there's a lot of opportunity for innovation. And hopefully, right, the government will support it rather than squash it. Yeah. I think we are out of time. I don't want to hold people over the time. I'm sure Tarun will be happy to talk to people afterwards offline. But I want to, again, congratulate you and thank you for this really insightful report.
thank you so
and
much.
thank you to all.